All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. Market's got about an hour and 10 minutes until the close here today. And one thing you know is that if the market is, some of the top headlines are debates between Republicans and Democrats, there's not a lot going on in the market. And that's kind of what we see here today. There's really just not a ton out there in terms of, major market headlines or major market drivers today. And we are seeing, the market's pretty flat. They opened with a little bit of a gap down. They erased that gap fairly quickly, and then they, just kind of sat. Just absolutely sad. I mean, here's the Dow, or the SPY, right? 0% change on the day, right? You look at the IWM small caps; they are lagging here today, as they continue to lag, right? This index looks different than the Dow. It looks different than the SPY. It's a very different index, and it's one of those big bad flashing warning signs out there that let's face it, when you go and you look around the market and you look around some of the market news and analysis, it's not being mentioned, it's not being talked about. It's not one of the things that anybody's looking at to say, hey, you know what, there could be some trouble in the future. And maybe rightfully so, because you know what, if they were looking at it back here, they were looking at it back here, you know what, it didn't come to fruition. But we're talking about a major lag in small caps over the last 6 months, major negative divergence in small caps over the last 6-7 months, and that's not going away. In fact, it's amplifying more than it is going away here for the sector. But all that said, market vibe today is a 2. We continue to kind of just be in this neutral area with the market vibe, and it's one where there's no real sign that it's ready to change, right? I mean, the market vibe, it's been trending neutral, and yeah, it's reading a 2, which means the bulls have more advantages than the bears. But, since this thing triggered neutral, the market had like 2 up days, and then the market's just been pretty darn flat. You can see here in 2019, though, neutral days have been slightly biased to the upside. Right, more than something like a 2018 where neutral days were slightly biased to the downside. But in 2017, neutral days slight bias to the upside. 2016 neutral was slightly biased to the upside. But overall, it's one where there's just not a lot of gain coming in the market on these neutral days, and we're still in it. We're still in this kind of neutral period, and waiting for some sort of break or spark or something to drive the next trend here in the market. And what's going to change? We've talked about some of the things that could change to kind of alter this, and number of stocks trading above the 7 or something like that. But where the number sits right now, a move to 5 by Wednesday would trigger a new bullish signal. A move to -1 by Wednesday would create a bearish signal. So that's what would have to happen, right? Not saying that's going to happen, but that's what would have to happen to create those signals. If by Wednesday we're just chopping in between that range, it's still going to be a neutral, and we're not going to see a whole lot of dynamic change here. If you look at something like the bullish percent index, it's just kind of hanging out, just kind of chilling out up here, in this 75 to 80% area. Not uncommon for it to do that. It's one of those where we see this quite often historically, where the bullish percent index will go hit a level and just kind of chill there. But, it's something where we're not seeing any kind of dynamic movement in it to suggest something different or something game-changing going on in the market. I talked about the small caps, right? And the small caps versus the large caps and the negative divergence we're seeing over the last long while here. And let's see if I can pull it up here. Performance. And if we just take small caps versus large caps, you can see it's over a 2% differential. Right. This is one of the reasons why we saw the market vibe go down last week on an up day. because the differential between small caps and large caps, it's now greater than 2%. In fact, over the last month, small caps are negative while large caps are up, what, 1.5%? 1.8%. So over the course of the last month, this is quite a bearish differential and nowhere near oversold. If we come in, I mentioned over the last 7 months, this kind of, hefty divergence. You can see over the last 7 months, the SPY is flat. Small caps are down 8.8%. That's a huge differential. That's a huge differential. And you say, well, maybe it's just because it's 7 months. We'll go back 8 months. Do we see anything different in the data? Well, it's even bigger differential. 8.79 versus, negative 8.79 on the small caps versus plus 2.88 on large caps. It's a very large differential. It's the type of differential where, we have to go back to 2007 to see it. If I come in here to a 5-month period, you can see it's a 5% gap between them, no matter what time period. And normally with an indicator like this, you can kind of go different time periods will give you different readings. But no matter what time period you look at, we're looking at small caps lagging, and that's not going away. And that continues to be, one of the more bearish arguments out there. But in and of itself, by itself, doesn't hold water, right? And when it comes to the market vibe, it's a collection of things like this. And, even with the bears having this, the bulls still have a few more advantages overall. So anyway, that's where the market is today. Lots of earnings up and coming here over the next little bit. Today, this afternoon, into tomorrow. In fact, if we come in, I'll just pull up the calendar here. You can see that after the bell here today, we'll have Range Resources, Whirlpool, so a couple, nothing too major there. STLD, I believe, that was before the market. I haven't seen them yet. But if we come into tomorrow, Twitter, Snap, eBay, all out, Snap and eBay after the bell, but before the bell, Coke, Twitter, Verizon, Procter & Gamble, United Technology, Harley-Davidson, JetBlue. It's a whole slew of earnings, Lockheed Martin, Hasbro, big companies coming in, reporting earnings, and going to be a driver, possible driver there for the market, and very interested to see how some of the tech reactions are as we go forward. Very interested to see how stocks like Verizon and Procter & Gamble react, whose valuations are pretty full. Right? When we look at these companies, you look at their balance sheets, you look at their metrics, their valuations, they're highly valued, right? And it's a term that's used in the industry to say, hey, the valuations are full. Meaning it's not a big discount. You can go out and take a look at AT&T and go, well, from historical valuations, there's a big discount here. But when we look at something like Procter & Gamble or Verizon, their valuations are pretty full. Even in United Technologies, their valuations are pretty full. It'll be very interesting to see how they react, here to the earnings here tomorrow morning. Okay. So anyway, those are some of the things kind of going on, and it's not a whole lot going on with the index. Now for the challenge test here, entry triggers this afternoon. There are none here this afternoon, and I want to kind of speak to this. It's I got a question asking me about straddles. And the question came about because when we look at what is triggered here so far, here for the algorithm, we look at what's triggered. Netflix, has it moved big? Yeah, you betcha it's moved big, right? We look at GOLD, has it trended and moved big? Yeah, you betcha it's moved big. We look at Nike. Has it moved big and trended? Yeah, you betcha it moved big and trended, right? When we look at the triggers, right, that have come in, the triggers are designed to look for trends. They're designed to find stocks that have a high probability of trending, right? That's kind of the easy part to finagle out when it comes to the algorithm. That's kind of the easy part to say, hey, you know what? This stock, it's likely to go on a trend right now. The harder part, or the more difficult part, is what direction, right? Is it going to trend up? Is it going to trend down? And probability states that, hey, you know what? There are a few factors that come in. We see those. Generally, the trend is that way. But it can reverse, and it can reverse very quickly. And we've seen that happen with these, and they've pushed into a heavy trend. Now, Netflix would be a bull signal here today, but there's something else in the algorithm that talks about where Netflix is right here, right now, and is there further trend left? And when you start to get this large of a move, it starts to kind of diminish the possible returns of that trend. It's still pretty close to a signal, but it's not quite there. We'd have to see Netflix pull back about $4 into the close for it to, trigger there with it. But going back to, can you play straddles on these? Yeah, you could. You could play straddles. You could buy calls and puts on them because that's what it's looking for. The biggest thing is looking for trend, right? And if you're right on the trend, one side's going to go up by more than 100%. The other side's going to go down by max of 100%, right? So, you're going to be able to, do very well with that. For the challenge of not going to apply straddles or any type of option spread, we're going to look for getting the direction and being in the right direction. If we're not in the right direction, backing out, and on occasion, flipping and going into that right direction. We haven't had the chance to do that here just yet, but anyway, yeah, these are. This algorithm, it's looking for stocks that have a high probability of trend. And it's one of the reasons why we can go out and we can look at an Apple here today. And we can say, well, okay, here's Apple. Yeah, path of least resistance, probably higher, right? The trend is up. But this isn't a new and emerging trend. This is a trend that's, already going. It's a trend that triggered and started back here in March. And you know what? It hasn't given any kind of re-entry points. And when we go to a lot of stocks in this watch list, we're kind of looking at the same thing, right? Now, IBM, we see some changing going on here. Some, big gap down, some possible change. But you'll notice there's no trend. There's just a gap and sit. We're not talking about a new trend formation here. We're just talking about an earnings gap. If we come in and look at something like an Under Armour, right, which was close to triggering here today, on Thursday, did not get the follow through or confirmation it needs here today. But this is something that's been in a consolidation now for 2.5 months. Right, 2.5 months consolidating. Is it ready to break into that next trend? Now, so far, it's suggesting no, that the consolidation risk is still on, that the consolidation risk is still high. And so we can kind of look at any of these, and we're going to see kind of that element where they're either they're mature trends, right, like an Apple or a Walmart or something like that, or they're not kind of emerging into a new trend. And, with this algorithm, that's what it is looking for. And, you'll find most stocks that trigger, they're going to move. They're absolutely going to move. Will they move? Will they move in the direction that they signal? Not always, but they are absolutely going to move. And that is the first thing that you have to find when it comes to options, right? You have to find what's going to move, and something that's highly probable of moving. So that's step one. Step two, obviously, getting the direction right, because you had the direction wrong. That movement kind of doesn't feel great, right? It doesn't feel real good, but overall, you get a couple right. You can handle a whole lot that are wrong as long as they're trending. It's flat that kills, and that's what this algorithm is designed to do, is to get rid of flat. And I got a couple, one of you commented to me on this ATR method, talking about this stopping mechanism in this one ATR, and made the comment, well, isn't that really tight? I said, yeah, it is kind of tight. But it's not very tight when we think about what these signals are. When we think about, hey, these are trend signals, right? I think you could argue 3 days without triggering step 1 or 2 equals an exit. That's really tight. That's really tight. Not giving it more than 3 days. We go look at a lot of trends. Sometimes they'll have 4 or 5 day pauses. And I even made the comment that when we go live with this, I'll probably bump this up to 4 days. But everything here is geared to, hey, we're trending or we're out. We're trending or we're out. And that's what that's what the algorithm is. So can you play straddles on it? Yeah, absolutely you could. Not a bad strategy. Not a bad strategy at all. Will I do it for the challenge? No, I won't play straddles for the challenge. So anyway, there we go. So nothing really to do. No new trades to make here. Nothing to run with here with it. Hopefully we'll get something in the morning. Hopefully we get something that comes in and triggers. There's some possibilities that could emerge. Here tomorrow morning. One of them's Micron. This is one that's close, but not there yet. It's one where you can see, the stochastics 39.1 is still above 50 here, but it's not emerging into a brand new trend here just yet. Nice little reversal on it here today, though. Was kind of red this morning, and reversing on up, but no real signal there yet. Western Digital not reversing to the same degree there. But, all eyes in tech tomorrow morning are going to be on Twitter as they report earnings. And, Twitter's going to have a big gap tomorrow. I mean, you go look at Twitter earnings, it almost always has a big gap. And the options are definitely priced for a big gap when it comes to Twitter. Whenever I look at Twitter earnings, I always think to myself, look, the potential for gap down or the size of a gap down is probably going to be a lot larger than any potential gap up, right? For it to gap up, what does it need, right? It kind of needs some buyout talk for a monster gap up. If it just beats, it'll gap up, right? And it'll gap up a little bit, and it'll kind of do something like back here in October, right? It gaps up, and that's a big move. I mean, plus 10% double-digit move here. But when it comes to earnings, which magnitude of direction is going to be larger, a gap up or a gap down? Generally, with Twitter, the gap downs are going to be larger than the gaps up. When it comes to earnings, not always. But, it's one where I think option makers have the price of the stock or price of the options right. I looked at, I looked at, where the options were. Thought, they probably have it right here. And, something where, you're going to have to get blindsided to outmove what the options have priced into them here. I think, there's a gentleman named Rubini, and he's a famous bear. And in fact, let me pull it over. Here we go. It's on Market Watch if you want to check it out, and it's an opinion piece. I normally don't bring up opinion pieces, but this guy's a market bear. He's always been bearish. Ever since I started in the market, he's been bearish. And he's always been very sour bearish, very, just not really recognizing the upside risks. There are a few times where I've seen over the years where he's talked about some of the upside potential, to the markets. But interesting piece in here from him, and kind of looking at things. But the bottom line, he talks about how, markets continue to go up, right? Markets continue to overall rise here, but the risks haven't gone away, right? The risks haven't subsided. In fact, you could argue some of the risks have gotten worse, and that's kind of his argument here. Take it for what it's worth there. There's several people like this out there. They're either always bullish or always bearish, and they make very similar arguments. But, it's one where, his first argument is price to earnings ratio is high. Oh, come on. Price to earnings ratio has been high for 10 years. That's not something, different. That's not something, where you look at this market and go, well, that's an additional factor. But as you get down, he does bring in some other factors here. Trump and Mueller report, okay, we've seen a lot made out of that, but the market's not really caring. But very interesting read. I think if you want to kind of look at how weak the bulls, the bearish position is, yeah, you read this. And if you read it and you kind of look at what's really going on out there, you say, yeah, you know what? These are all risks, but they've all been risked for a while. There's no new risks for the market to price in. Right? There's no new risk for it to price in, and that's where kind of the crux of the matter comes. Where if there's not a new risk to price in, the old risks, market's dealt with and understands those risks. Something dramatic has to change with those, and he does make that point. They each need a catalyst. Something has to change. These are potential areas where something could change, where that catalyst could come from there. All right. Thanks for hopping on. Tomorrow morning we'll jump on to do the trade challenge automation sheet. Then afterwards we'll go and take a look at some of the other categories that are on that spreadsheet. Discuss those in detail, why they're there, and what they have to do with, and we'll make that happen here tomorrow morning. Thanks for hopping on. Have yourselves a great one, and we'll talk to you later. Take care.